This AI-generated podcast is for general information only and does not constitute financial or legal advice. Listeners should independently verify all information. Please consult a qualified professional.
Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 1st June 2026.
So, stepping right into our analysis today, we are examining the strict operational parameters governing financial sector communications. And the primary thesis that we need to establish from the outset is that any marketing communication must be rigorously classified, tested, and recorded to ensure it is fair, clear, and not misleading prior to distribution.
Exactly. That's the fundamental mandate. But before we analyze that specific machinery, our first core takeaway is establishing the regulatory perimeter. We have to clearly identify when these rules are actually activated.
Right. And the baseline for that perimeter is Article Sum 732 of the Luxembourg Law of 5 April 1993 on the financial sector.
Yes. For clarity, we will refer to that as the 1993 LFS Financial Sector Law. The rule under Article 3733 of the 1993 LFS Financial Sector Law dictates that client information cannot be misleading, and marketing communications must be clearly identifiable as such.
But this standard isn't just a blanket rule for any corporate document. The application is conditional. It specifically targets credit institutions and investment firms, correct?
Correct. A credit institution is defined as an entity that receives public funds and grants credit. An investment firm, on the other hand, is defined under Directive 2014-65-EU, which we will refer to as the 2014 Method 6 Directive.
Okay, so if a legal person is professionally providing investment services, they fall under the 2014 Method 2 Directive.
Right, and the specific services that trigger this level of scrutiny include investment advice, portfolio management, and order execution.
So if an entity distributes a document that even references portfolio management, they cross that operational threshold. They are actively distributing a regulated communication.
Precisely. Which instantly brings us to our second core takeaway, the three-step control process. As we established in our primary thesis, the firm is now required to classify, test, and record the communication to ensure it is fair, clear, and not misleading.
Let's break down those three procedural steps.
Yep.
Step one is purely about classification, right?
Right.
The compliance team has to map the document against the service perimeter we just outlined.
Yes. They conduct a structural review of the text. Does it mention advice? Does it reference custody of assets or structured products?
And once they confirm the classification, we move to step two, which is the testing phase. And this seems to be where the most intensive legal vetting occurs.
It is. Every single claim made in the text must be balanced. If the document highlights a potential benefit, it must be meticulously balanced against the relevant risks and costs.
Meaning you can't just emphasize a high potential return without providing equal prominence to the potential for market loss?
Exactly. Visual and contextual balance is a strict standard. And this testing phase also applies separate verification for ESG language, environmental, social, and governance claims, and tax references.
Because tax implications are highly specific to the individual client reading the document.
Right. A blanket tax-free claim could easily lead to compliance non-conformity if the client resides in a different jurisdiction. Furthermore, the testing phase incorporates product governance rules. The target market documentation has to perfectly align with the text.
So you couldn't use mass market, retail-focused language to outline a highly complex institutional product?
No, you cannot. That would represent a procedural discrepancy. You must align the complexity of the communication with the legally defined audience.
Okay, so we have classify, we have test. Step three is the record phase. The firm must maintain an exact audit trail of this process.
Yes, the approval process must be comprehensively documented. The firm records the specific version, the designated approver, and the exact date, and this must all be finalized prior to circulation.
Does this mean the firm has to submit the documentation to the regulator for pre-approval?
No. Article 7732 of the 1993 LFS Financial Sector Law does not require a recurring submission to the CSSF. The firm maintains the records internally, but if there's an audit, they must be able to produce that documentation immediately.
Right. And returning to our primary thesis, that entire process to classify, test, and record is mandatory to ensure the communication is fair, clear, and not misleading.
Exactly. Now, having outlined the current operational standard, our third core takeaway addresses how this regulatory framework is evolving. This brings us to the retail investment strategy.
which is a package of proposed European Union legislative reforms targeting retail investors.
Yes, and a major milestone occurred recently. The retail investment strategy reached a political agreement on 18 December 2025.
The primary objective there is to strengthen investor protection and harmonize the framework across all EU member states.
It is. However, there is a critical legal distinction we must emphasize here. A political agreement is not a binding law.
Yeah.
It still requires formal adoption by EU institutions and official publication.
Right, publication in the official journal of the European Union. And even after that, Luxembourg must assess the text and formally transpose it into domestic law.
Exactly. So until that local transposition is finalized, enacted, and published, firms must continue to operate under the current baseline.
Meaning they must rely on Article 37.310 of the 1993 LFS financial sector law. Implementing the proposed strategy too early could result in operational gaps regarding the current active statutes.
Precisely. Firms should monitor the horizon, but their daily operations must remain anchored to the binding law of today, which reinforces our primary thesis one final time. Under current law, firms must systematically classify, test, and record all marketing communications to ensure they are strictly fair, clear, and not misleading prior to distribution.
Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Listen also to the French edition of the Luxembourg Fundcast.
Subscribe to Bertrand Mariaux and Rigor Media on YouTube. Connect with Bertrand on LinkedIn. Read the full analysis of the podcast at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.